All right, folks. Well, welcome and great to see you all. Uh, Nazca says, "Have you heard of the Fed's infinite QE?" Yes. Well, we've seen that in the share in the price of the Dow a few moments ago, running up the page. Thank you, Diana. Okay. Uh, so let's make a start, folks. We have a guest speaker later on, so I need to be very quick. There's not a great deal that I can say anyway. We sit and in the immortal words of the Duke of Wellington, I await the dawn, if anybody's read the Duke of Wellington's memoirs. That's what he used to say before battle. Hello, Bill. How are you, sir? There's Ed Jones. Ed is saying that our grandkids will pay. Yes, it has to be paid for, Ed, that's for sure. Hope you made some good money on the short side. And Julian as well, good afternoon, folks. Let me get this disclaimer out of the way. I'm not allowed to give one-on-one financial advice. I'm allowed to talk about shares that I'm interested in myself, but I have to make it very clear that although those are suitable for me, they may not be suitable for you. Okay, so that said, we can move to the only thing that's really, really important this afternoon, and that is the state of the overall market. As you know, VectorVest believes that we should know what a share is really worth, how safe is it, and the basic prescription is to buy undervalued shares with safe trading records that are rising in price, and we want to buy them when the general market is rising in price. And I've always said that the general market is 70% of the exercise, and I think we can see that quite clearly over the last month now. A month ago in this room, I said, prepare to make some very, very difficult decisions. I didn't think they were going to be this difficult, but nevertheless, prepared to make some difficult decisions. I'm gratified to hear that many of you have, in fact, taken your stop losses and are now sitting in cash and awaiting, as the Duke of Wellington said, awaiting the dawn. And I'm not sure when that's going to be, folks. So let's look at the state of the of the markets itself. So let's just get out of that. And I've got VectorVest UK here, and we've got 59 companies on a buy. And if you have a look at those, a lot of those are actually totally illiquid, inverse exchange traded funds that are on a buy recommendation. Many of them located in Europe that we actually can't trade at all here. There's 1,765 companies on a sell, and the buy-sell ratio right down at 0.03. MTI, which is the momentum of the VectorVest composite and the momentum of the buy-sell ratio, all rolled into one, on a scale between 0 and 2, is at 0.3, being a tad lower. The short-term trend is down, the longer-term trend is down, and that longer-term trend has been confirmed by price action, so we've got a confirmed down in place. Now, I think, folks, and I'm certainly going to try and follow the rules myself, and I'm not superhuman. I struggle at times with missing out, the same as everybody else does. But nevertheless, I'm going to wait for at least the primary wave to turn up, and hopefully a little bit of green in the price column of the color guard. There'll be plenty of time to get in. In discussions with Steve Chappell, I may have mentioned this last weekend, I may not have. In discussions with Steve Chappell, who in fact is the prime mover in the VectorVest bottom fishing course, he believes that the number of advances should in fact be twice that of the number of declines on that particular day. So the minimum requirement, Nigel, I think one would like to see maybe green here, but I think that you should keep an eye on that window of the advances against the declines that you can put up. And I'll show you it in a second when we get to the American market. So as far as I'm concerned, nothing to do. I'm not quite sure Jean-Kill, what you mean there. It's just the number, the advanced decline is the number of shares that went up that day divided by the number of shares that went down that day. So we're looking for some short-term market bred that the turn, so that the turn didn't happen on a few shares. That's all we're looking. Sorry, I didn't put that well. And that's after me. I complained this morning to the president of South Africa that most South Africans would not know what social distancing meant, and that it would be better to say stand 2 meters apart. And I got a reply, believe it or not. I got a private message back. So maybe my English needs to be a bit plainer myself. So that is absolutely nothing to do. I've got the charts here. Rather than putting them up again, I'll just put them up here. That is the confirm call, and as you can see, this market has sold off with MTIs down, the buy-sell ratio was right down, and we're in a mega oversold situation, but we still got a long way to go before we would in fact get any form of bounce here. And as you can see, closed down on Fridays. That's the DEW signals. I kept the DEW signals with the MTI and the buy-sell ratio, and I think Carvin's going to speak about those a little bit later. Okay, Diane. Well, you have to explain that to me because I didn't understand it. Now, I got a message from Mark up, who is a prime mover of our Manchester user group, and he in fact showed me that within this there's probably 5 waves. If you actually look at the structure, we'll see it a little bit more clearly in the American market. I've been asked by many people as to when it's going to stop. That's the composite, and as you can see, hasn't particularly obeyed this 78% retracement. So it looks to me as if it can get down to this low that happened in 2016 now. That's where it's going to go. Oh, thank you. Gold's up a little bit, Nigel, that's for sure. I'll have that in the presentation in a second, but I need to keep going because I don't want to take too much time because there's really not that much to say. The pound against the dollar, I was looking for a buy just about there last week, and of course the thing fell out of bed. I didn't make any money, I didn't lose any money, but I'll now be looking actively for a reason to buy the darn thing somewhere down around here. That's my trading strategy. Many people laugh at it. In fact, I was laughed at last week by many people. They said, why didn't I sell it there? But to have sold it there, the stop loss needed to be huge. So I always try and get aboard at the decision point where the risk is least and the opportunity is most. So I'm looking for that again. So I missed out on this last week. It didn't, in fact, suit my trading plan, which is, as you all know, based on Mr. Wyckoff in short. Yes, George, you're right. George says beautifully that the market will stop falling when people stop selling. Yeah, you're quite right, George. And we're probably a way off that. I noticed in the paper this morning in the Telegraph that a lot of insiders are buying, but on the next column, I also noticed that the hedge funds are in fact very short of the market. The euro, again, I was looking for a bounce there last week. Didn't happen, and I'm now looking for another one down here somewhere. As you can see, both stochastics are in a buy area. I rode that down based on this thing, but it's now. I would expect it to get to that 127 level. The pound is there already, so that's what I'm looking at for this week. And of course, we've got JD, which is at exceptionally good levels. I've done nothing yet. Avon rubber looks exceptionally good to me. You see how it came off that particular level. So those are 2 shares that I'll be looking at when I get at least the primary wave up, and the number of advances on that particular day are twice that of the number of declines. So Avon looks very strong. If you do, Susan Thornborough so many years ago now showed me how to do a performance chart. Do you remember that, Susan? So if you actually look at Avon against the general market, it's fallen much less than the general market. And Games Workshop, I think if I was doing a course on confluences, this would have to be in it. We've got this old top, I've got this trend line, and I've got the 78% retracement all coming in around that level. And if I did a daily chart of this, you can see that people were in fact tickling it at that particular level. So I don't think you have to go look much further than that. I have put together a little list, and folks, I sent out a video last week which looked at big American companies, but I think in this environment, we want to err on companies that have got, this is my watch list just here. And that's what I'm looking at for a turnaround. I haven't bought any of them yet. Avon Rubber that we've looked at. Let's look at all of these for a second. I don't want to get into Carwyn's time here, but Avon Rubber, as you can see it came off that level. Still early for me yet. There is lying. Somebody bought it down there, and there's a lovely confluence there as well. See that confluence of trend line, old top, and a 78% retracement. Just that'll have to go into a textbook if I ever get around to writing it. That's JD that we've looked at. That's Games Workshop that we've looked at. That's Marshall's. I'm worried here because there's an old high at £5, and it could stop at this, but it's not quite as pristine as the rest of them. That's Diploma finding support here, and Halma. And there's a trend line just here. It can quite easily get back to that trend line. With any luck, these levels will hold it. Had a very good day on Friday. And last one is a GB group. Again, beautiful confluence, earnings per share rising. So Bill, I've tried to tie in what Bill and the two Marks have been talking about, re the earnings per share kings. This is a time, folks, to look for very companies with exceptionally solid balance sheets. So those of you that are accountants that are good at this, get in there and sort out and to your satisfaction shares with outstanding balance sheets. For me, I shall be looking at high RS shares and high RS shares that fit the bill of what Mark and Bill have presented, earnings per share kings. Okay, that's what I'll be looking for. Okay, Simon, thank you. Simon asked, is there still some time to get into SUK2? Simon, I don't know. For me, I just couldn't sell it down around these levels. So there probably is, but I just couldn't do it. Okay, I would be feel that I'm selling at lows. So let me now go to the American market and let's have a look at the US markets. Now we have it again. We got the same thing. Now on this, I put up this window of advances and declines. And if you play with the darn thing, you'll be able to find that window. If you can't, Derek from our Guildford user group put it up for me the other day. Susan showed me as well. But give support a call if you can't find it. All you've got to do is to hit this little spanner up here and it'll magically appear. So what I've done here is that I've got the a visual number of shares on a buy divided by the number of shares on a sell. And as you can see, you don't have to be a rocket scientist to see that there's a great deal of shares on a sell recommendation as opposed to a buy recommendation. And the advances on Friday weren't bad, but the declines were more. And as you can see, we've got a red light. We've got a black star in the red light, which is telling us that the price of the composite is falling, and it's falling hard. The short-term trend is down, the long-term trend is down, and we've got a confirmed down. So too soon to do anything. And that was the situation on Friday. We got a close right down around here, and a very, very bad close on Friday indeed. That is the close-up of the same thing. There's the DEW. And the DEW just sitting. That's why I'm no fan of bands, folks, because you know, if the market trends like this, it sits outside these bands forever. And as you can see, that was the DEW signal there. I think no, it's a confirmed call signal. I forgot to change it, but a long, long way from any signal on the DEW. No, stick your toes in, Trevor. Stick your toes in. If it goes your way, then buy it. Okay. DEW is a market timing methodology, Diana. It stands for a detrended price oscillator, envelopes, and a weighted moving average. So really all it says is that when the price is below this red moving average and the momentum indicator is below its center line, that it prints a sell signal. It's a very simple, robust indicator, works exceptionally well in trending markets, bloody awful in a ranging market. Like all moving averages, Diana, like all moving averages. There's the Dow itself, and that was that close in the Dow on Friday. As you can see, we've had lots of these good days up, and they've just come to nothing. The last thing there was the Dow at 12:30, so that's what, an hour and 20 minutes ago, and we had this nice push up caused by some news on unlimited quantitative easing that Ed Jones so beautifully puts that we'll all be paying for a couple of generations. So it died on the open, Christopher says. So let's see if I've still got that chart open. I'm not quite sure. Yeah. There you go. That's the chart. There was the run up this morning, and it all came right back to next to nothing. Those of you that are trading intraday, folks, the volatility is incredible. And if you get caught on the wrong side of one of these moves, these are 1,500 point moves. Well, and you have a moment of weakness, or the market maker won't let you in or out, then you can blow accounts big time. So it's come right back to the support level again. And a huge, that's a 1,500 plus point swing up and a 1,500 point swing down. It's too much for me. Okay, I'm just going to leave that well alone for the time being. So let's go a little bit further. That's the SPX, or the S&P 500, and it's taken out this December 2018 low. The next level of support will be down here somewhere at that old high, and then we have to go right back for forever to find another level. But the next level will be down around here. So that's a couple of 100 points away. These are bear markets over the last 50 years. I dug this out. I don't know where I got it from. I think a friend of mine, Investec, gave it to me. History lesson, young folks. That's what Johnny Cash used to say ahead of every concert. He would introduce the band and he would tell the history of the band. History lesson, young folks. I listened to him once in, where was it? Cleveland, Ohio, years ago. There's the 2009, 57% it came back, and we've actually come back 32% already on this particular move. So anybody who wants those statistics, then I can send that to you with the greatest of pleasure, okay? These CDs are calendar days. It happened very fast. CD is a calendar day, all right? If these levels don't hold, we're in big trouble. So folks, I think you have to assume that we're in a very strong and miserable bear market here. We're due a bounce. I felt that bounce was going to come, but I have no idea when it's going to come. So let's just trade the market and not the forecast. And it's showing no signs of of coming soon, and so. But we are in a bear market, folks, and I would expect it to bounce soon. If any of you that haven't got out, then I think that if we do get a decent bounce, you should consider running. I think that it needs to close above 78% of the fall before I'd be convinced that we're not in a bear market. And as you can see from this chart, these bear markets can last 17 months, 21 months. That was fast in 87, but bear markets last quite a long time. Yes, Lillian, I agree with you. Lillian says they can last a couple of years. I would have thought so, Lillian. So no US positions. Gold. I expected gold to bounce. As you can see, both my stochastics are down at the oversold area, but I still think that this will fall after that. And you know, the economists are not much use, because I see one in the paper this morning, university fellow, saying that we've got stagflation, which should be good for gold. Another one says we've got deflation, which is going to be bad for gold. But I would expect that we're going to get a rally here, and that there's more downside in the gold market. Oil, nothing to do as yet, but on major lows, and maybe played out for the time being. As you can see, 1, 2, 3, 4, 5 there. Maybe a 2 to 5 day, 3 to 5 day bounce on the oil price. Some of you may be interested in that. There's the Canadian dollar, a proxy for the oil market, extended like I've never seen it extended before. And the copper market hanging in there better than I thought. And with any luck, the copper market will actually lead us out of this. And that's probably because it's, in fact, discounting China getting better. I have some good contacts in China, and they tell me that factories are nearly back to full production, although there are supply chain problems in the way. And that's the long-term chart of copper, folks. And as I say, this needs to mend its ways very quickly, because this is a trend in copper that's been in place for a very long time. If that, in fact, were to actually break on the downside, that would be one hell of a move in copper, and that would definitely be a deflationary period. So a very important level on the copper chart, just around here. Very important level. I can't overestimate how important that level is. Okay, so I hope so, Stuart. I hope so. Michael, I don't know. Michael, I don't know. I honestly don't know. I've given you that from my heart. That's all I think. Okay. So we had immense problems in GoToWebcast this morning, and Carwin, Thomas, and I tried to do a test, but unfortunately that was not to be. I sat on the phone with GoToWebcast. I managed to keep my temper. But it was close call at one stage, but nevertheless, I managed to hold on to it, and hopefully they fixed the darn thing. So we've got Carwin in the room. We didn't get a chance to do a test, but I'm going to make him the presenter now. Now, Carwin is a microbiologist, a fellow that would be very useful in this environment. Donald Trump could do with you, Carwin. So he graduated in microbiology and has worked in the pharmaceutical industry for 30 years. He's given that all up, and he's now a farmer in Gower with his wife Sue and his dogs and horses. It sounds absolutely ideal, Carwin. So let's have a go at this, sir. I'm going to unmute you now so you can say hello. And I'm going to make you the presenter. Okay.
Okay, David, can you hear me?
I can hear you, sir, and you should see a big button in the middle of your screen. And if you click on that button, we should be able to see your screen straight away. Yeah, there we are. So, Carwin, welcome.
Okay.
Welcome, and we're looking forward to your presentation. and I'm going to mute my machine now so we don't get that feedback thing. I'll take any questions that are coming in. Folks, before I go away, just wait. Just sit and wait. I know you're all interested in getting in. Carwyn will have something to say about that now. But this may not be over. So just calm yourself and buy yourself a six-pack and enjoy a drink or something. It'll cost you £4 out of Tesco.
Bit of Gower Gold, David.
Yes.
Bit of Gower Gold.
Okay, Carwyn, welcome, sir.
Thank you very much, David. Hello, everybody. David has asked me to do a presentation on the nuances of market timing. I must say, it seems very, as an avid listener at the other end of the microphone, it seems very surreal to be at this end and the giving end of it, I must say. So we'll do our best in trying to adjust this. Thanks to David and all the previous presenters, I think everybody would agree that we get some fantastic value for money with some great content and education. So thank everybody for that. I've titled this this talk with a question, in fact, which I think we should ask ourselves. The question whenever we are sitting in front of our next investment decision, and that is, ask ourselves, is the canary singing? Are the indicators rising with price and trend? Okay. Just some start points here, but what I want to try and cover, if I can, is it's quite a charty presentation, but without going into the actual VectorVest system, obviously, it needs a few charts to in sequence to show some sequence and some follow through to the signals. Thought I'd start very briefly with my investment and trading plan, why I'm here in terms of what I want to do, what I want to achieve. The strategy of both the worry-free and the swing trading strategy, which David has alluded to over the years, and trying to get the right balance between those two strategies, using the market climate graph for the big picture, so to speak, with the macro climate, and a quick review of the market timing signals, which will obviously depend on our investment style and obviously our risk profile, and then go on to the individual components of the MTI, the BSR and the RT indicators, and how I've customized those on my own home page just to make life a bit easier and try and see the big picture from the front page. And I thought I'd try to make the talk a real-life case study and talk about the last confirmed call cycle as opposed to a theoretical one, and then talk about the rising indicators or the importance of the rising indicators in rising markets confirmed by price and trend for market timing. And very briefly then go on to mention how not all confirmed calls, or any signals for that matter, are made the same. They all have a different nuance, and it depends on the mix between price, MTI, BSR and RT. And I've given a couple of examples here of shares I was in recently in the last cycle, the ones that we know and love over the last few years, particularly Lion Trust, Asset Management, Games Workshop, and also SUK2, the FTSE short, double leverage short ETF, which I use occasionally as a hedging tool. And then go on to talk about the checklist that I tend to ask myself for the next investment, and conclude on where we are now. And I think hopefully what you'll find is that this presentation was quite timely in the current market conditions, and will resonate with, in fact, I don't know whether anybody had the chance to listen to Todd's Strategy of the Week presentation last weekend, and also it'll resonate obviously with David's Essay of the Week, which he wrote last week. So, in terms of the investment plan, why and what I'm trying to achieve, it's basically, like most of us, I suppose, it's a supplemental income from a work pension for myself. So a combination of capital gains and dividends in tax-efficient wrappers like ISAs and SIPs. And very important, like us all, to protect and maintain today's buying power for tomorrow. And I've set myself a minimum hurdle rate, what I call the hurdle rate of return, which is the total cost of are cost to capital when invested, which is the cost of RPI inflation, interest rates. Well, that's a bit out of date now because obviously we've just had an interest rate cut around the world. And also the cost of investment with software and broker fees, etc. And how I use the VV, the VectorVest market timing as a guide for when to buy, what to buy. In other words, when to be bold and optimistic, when to be cautious, where we need to watch and tighten stops and protect profits, and indeed when to sell. And when we're bold, I try to target an average annual worry-free type investment return, and obviously that would be using the high relative safety stocks, typically going for double-digit return. And particularly in the shares that we know about, which are very much in the that category, like JD Sports over the years, Games Workshop, Lion Trust Asset Management, and the builders, etc. And when to be cautious, I consider, as well as defensives like cash, which is the obvious choice, I do tend to go into ETFs in other asset classes like bonds, physical gold, occasionally miners. I put a question mark there because miners can behave very differently at different times. And the use of the FTSE 100 short, as I mentioned earlier. And typically those ticker symbols there are in brackets VGov, which are the plain UK bond fund, index-linked UK bonds, INXG, ITPS, which is the inflation-linked treasury bond, gold, SGLN, physical gold, AUCP then for the miners, and SUK2 for the FTSE short. When I do use the FTSE short, SUK2, I use it as a partial hedge against capital loss if I'm still holding stocks. And the big caveat here is I always put an active physical stop into the system. And always remember David saying, whenever you use leverage, very important and vital, critical to use physical stops. And sometimes it's not just one or the other. Sometimes I'll own both the stocks and defensives. And it obviously depends on the nature of the market, which does change considerably, as we know. And the hardest thing to do is sit and do nothing. So cash is very much a position as is now. And we've got to be patient, wait for the turning point and confluence areas as confirmation for entry. And again, the aim is for the average annualized rate of return for the high RS stocks, typically 15% in the UK and the USA. In terms of the worry-free strategy, in the past I have invested the majority in high RS descending stocks, where typically the RS is above 1.3. And as we know, these stocks have a history of strong financial performance with consistent and predictable earnings. I like to look at RS as my look-back number. So these are historical earnings. So where we want to lean on safety, those are the stocks to go for. And I cherry-pick these with good RV values, typically above 1 as a minimum. And these RV stocks, they the look-forward number stocks, which give promising upside potential versus the risk-free rate, as we know is a AAA-rated corporate bond. And I use the combination of the two because I found that with quick test results compared to the simply searching for the top 10 RS stocks or the top 10 VS stocks in StockViewer, typically they tend to give better returns in combination. So that's something I use. And I also use the long-term winners search in Unisearch as well. Whilst I prefer to look for undervalued stocks, worry-free stocks typically today are quite overvalued, but the important thing is you have some look-forward upside potential using the forward RV, the relative value in VectorVest. So with a worry-free approach, I've tried to own these stocks longer term if the macro picture is favorable using the market timing chart. And I tend then, if you're position trading, I tend to obviously use the buy the dip mentality. And the investment mindset is for months to years. And in terms of risk management, use position sizing, no more than 1% risk to capital. Usually it's more like 0.75% if using a high substantial amount of money. Then with the swing trade strategy, in the past I've used this as a minority in terms of the total capital for high reward to risk opportunity stocks. Typically these stocks have low RS values below 1 and tend to be the commodity stocks, small cap AIM stocks, typically like miners or shares within the energy sector. And obviously, if I'm shorting with the SUK2, very important to be nimble and have a swing trade strategy. And the mindset is to rent these stocks for the short term and not own them for the longer term, as you have more of a sell into strength mentality with a resistance target in mind. So that could be a previous high, it could be a fib target, a percentage gain target, or a trend line break. And the emphasis, obviously, is important to be nimble, strong risk management principles using position sizing, which is critical. And especially in these stocks with RS below 1, these are more volatile, less predictable, and more cyclical stocks with cyclical earnings per share. Mindset here is to invest for months or longer, not days or weeks. So again, position sizing is below 1% risk to capital. More usually, rather than the 0.75% for the position trade strategy, it tends to be lower than that, less than that, at about 0.5% risk to capital. So in terms of the balance between the two, swing trade and position trading, I tend to use the market climate chart and to get the bigger picture. And as we'll come on to now in the charts, the FTSE earnings at the moment on that chart are down. The earnings trend indicator is down at about 0.85, so we're in the bear market for earnings. A little different with the S&P earnings up at the moment, but the earnings trend indicator is in a bull market at roughly 105. So still in the bull market for earnings in the S&P. But importantly, the expected growth rate is about going into this year, next year. It's about 8%, but it's slowing. And not so long back, we were looking at something like over double digits, something like 16%. And the power of long-term charts are very important. And I'll show a chart now of the BSR, which, whether I'm reading too much into the tea leaves, but they are forming lower peaks, suggesting a narrower market participation and narrower breadth during the rallies. So with swing trading, we sell into strength of the target. And as David has alluded to in the past, almost 3/4 of the exercise is based on when to buy using market timing, and the rest is on what to buy and when to buy for entries and exits. So if market timing is the majority of the exercise, in my view, I tend to focus, that's where the focus goes for me in terms of the energy effort in how to approach investing. So at the end of the day, it's a tailwind and not headwind in our investment journey. And if I briefly go on to the market climate chart, we've got earnings on the top half and the earnings trend indicator in the bottom half. We're in a case 7 bear market scenario at present, apparently in the UK. Earnings down, inflation down, interest rates down. And as you can see there, the growth rates expected for the various indices in the UK, quite modest at the moment, between 1 to 5%, something in that order. And at the bottom, with the earnings trend indicator, we're in that bear market scenario. The S&P 500, earnings in a case 2 bull market scenario. Bit of a different picture, where earnings are still up, inflation is down, interest rates are down. The earnings growth rate, as I mentioned earlier, was 8%, but question mark, is it slowing? With the earnings trend indicator in a bull market at the moment, still above 1, but again, question mark, is it slowing? This is a chart of the FTSE buy to sell ratio taken from the VectorVest market timing graph, and just blown it up basically. And it's I've taken it all the way back from 2009 to now, and as we can see, the peaks in the buy to sell ratio very much in a downtrend. That's not to say, of course, that I've drawn the green line there, where the BSR is considered to be very oversold. That's not to say that there aren't investing opportunities, obviously. And then same then for market timing chart for the BSR for the S&P 500, and taken back to 2004, a very similar picture again. So as we know, these are the market timing signals. I won't dwell on these too long, but I put the question here, which one for you? And it's very important to know yourself or know ourselves. I know it took me a long time to work out what type of investor I am. And I started the sequence there with Explosive Day, which VectorVest USA have alluded to in the past, which then leads to a primary wave. And in the first two letters in the trend column, when that kicks in on the upside, you get an up, followed by down. That then leads in sequence, hopefully, to the green light buy in the price column, which is then confirmed by momentum with the green light buy RT kicker, typically the flashing light in the price column. Then you've got your intermediate signal, the MTI underlying trend in the trend column, and then on to the confirmed call, which is highlighted in the call column. On the right-hand side there, sometimes they don't fire in sequence. They're quite interchangeable. And depending on what sort of investor you are, obviously the faster signals on for the more adventurous investor would be starting with a primary wave and then becoming slowest as you come to the confirmed call signal. So the higher risk is obviously at the primary wave end, and the lower risk would be at the confirmed call. For me, I tend to look at the green light buy as a starting point, and then get my watch list ready, leading on to the confirmed call, which I have more confidence in. Each signal has its own nuance, and that will very much depend, as I mentioned earlier, on the MTI, the BSR, and the RT numbers. And one thing to consider, of course, as we know, with the MTI above 1 is a condition for a call-up signal in the UK, where it's very different in the US, where it's the BSR, which is the condition for a call-up in the States. So, one way to keep an eye on the MTI, excuse the pun, but I like to, on the home page, I have customized the indicators with the color guard on my home page. This is the top half of the home page, so you can see now at a glance, if you didn't need to go into any other tabs in the VectorVest system, you can see that at a glance. And as we can see, we've had a massive decline in all indicators in the last few weeks. And just to complete the circle, this is the bottom half, and then I will look at strategy, and then to the left there's a quick list there of the various indices, including some of the defensive ETFs we highlighted earlier, including the copper and gold and the oil proxies as well. Below that is what I call the 3 flavors of VectorVest. So depending on what sort of investor you are, you can look at the proprietary VST stocks of VectorVest in the center there at the bottom. Those are the highlighted top of the list. Then you've got the worry-free stocks to the right, which are the top RS stocks. And if you're more governed by momentum, then there's the Midas touch stocks on the left-hand side. Okay, this is where the charts kick in again. Basically, I've looked here at the individual indicators. So, as we know, the VectorVest backtesting has showed that whenever the MTI gets below 0.6, the market is very oversold, and that's in fact where we are now at the moment, which I call the potential blast-off zone. Obviously, very early days yet and too early to tell. No bottom in sight yet. When the MTI reaches above 1.5, we typically know that the market is overbought with a potential topping zone. The green light there is the call-up signal, and the red light the call-down signal. And this is all in context now of the recent confirmed call cycle that we had from the 24th of October to the 25th of February. And the bold shaded area is the actual MTI, and I've also included there a moving average. I think it's an 8-day moving average, only for my own purposes, not essential, but it does try to smooth out the peaks and the troughs. And I've put there the uptrending phase, which is the time to be bold and accumulate stocks. You get the MTI then leading up to 1.5, as it did in the last call cycle. Then it began its downtrending phase, and that's the time to be cautious and more defensive with your stocks, etc. Consider selling, and of course consider any defensives in ETFs if you're so inclined. And in the highlighted box there, the MTI, you'll notice that the MTI bottomed out at 0.89, and that was on the 9th of October with the primary wave call-up. And it didn't start rising then until the couple of days later, the 11th of October, which is when the green light buy got printed. And then going through the 17th for the green light buy star, which is the RT kicker, going into 1 on the 21st, and then going above 1.14 rather on the 24th on the call-up. The important takeaway here is the MTI started rising before the confirmed call, which gave a nice signal, and that in fact started at the green light buy signal. All right, and then a similar trend then for the buy to sell ratio, often termed as the canary in the mine, and hence the title of today's talk, and gives us an indication of market breadth and participation. So the more buys than sells, and we get a nice uptrend. We've got history showing us with VectorVest that once the buy to sell ratio goes below 0.2, the market is extremely oversold, like now, and is just flatlining at the moment. But nevertheless in the potential blast-off zone. And then in the last call cycle, basically that led up to the previous resistance at, I think about 3.5. I've made a note there that previous resistance for one of the tops was about 4 to 4.5. So you can see there the uptrending phase to be bold, the topping phase, and the downtrending phase to be cautious. In the highlighted box there, the BSR was 0.45 on the 9th of October, which printed a primary wave, but then started rising then from the green light buy, just like the MTI, and we had a nice signal with a call up with the buy to sell ratio in that case was 1.43. So two good numbers there for the MTI and the BSR. And I've also done the same then for the recent call-up cycle for RT. RT a little less sensitive unless we get the big updraft or the big downdraft, sadly, like we've seen recently, and that really puts things into perspective with the weakness in the market recently. And again, basically, RT is market speed and direction, which tells us whether we're accelerating to the upside or the downside. And the RT, just like the other two previous slides, kicked in, started to increase at the green light buy stage leading up to the call-up. So basically, if just to summarize, we had a strong call-up signal, the last signal, on the 24th of October. It was reliably supported by the three indicators. They all were above 1, the three were above 1 and rising before the call-up was printed. And all three started to rise with the green light buy signal on the 11th of October. So next we need to align price and trend lines with market timing signals to give them some kind of context. So what I've done is, this is a chart of the VectorVest weekly price with a call-up signal that we've just cycled, that we've just spoken about. So that's on the right-hand side of the graph of the chart on the 24th of the 10th, leading up to the confirmed down. But I've taken it back, in fact, to a call-up on the 9th of January, which was the start, in effect, of the what I call the ascending triangle, where I've drawn the support line there from bottom right to bottom left, sorry, to top right, and then obviously the resistance, the two resistance levels there at the top. And now I've narrowed it down to, in the context of that ascending triangle, basically to the last call-up cycle. So we're now at the, this is the daily price of the VVC with the green light buy signals. There's the mature end of the ascending wedge formation, or ascending triangle formation, excuse me. And I've made a note here. There's your uptrend phase, your topping phase, and your downtrend phase, which is aligned to the three indicators we've just highlighted. And the importance there, the first green light buy following the last call down, which was triggered on the 11th of October. And it's important here because we're at the start of the uptrending phase. The three indicators start rising together in harmony. The MTI underlying trend and the buy to sell ratio canary start to sing. And although it's not shown in this chart as yet, all three bullish show bullish divergence with price, starting on the 11th of October, and that will be shown now on the divergence chart coming up. So at this stage, that's where I get my shopping list ready, and I look for follow-through of the market timing signals and wait for confirmation of price as well. There's the same VVC daily price, this time with a green light by star, which is the RT kicker with momentum. And I've highlighted here the importance of the last green light buy signal, which is the 19th of October. And this is important. I've noted here we're approaching the topping phase as the MTI is near 1.5 on the 19th of October. It's followed by a neutral signal, which is here right at the top, by the high. Price starts to trend sideways, and as we know, the MTI, BSR, and RT indicators start to top out as of the 6th of January, I think, of this year. And the indicators show bearish divergence with price, and that's shown now on the divergence chart coming up. So notice that the green light buy signals disappear in the topping phase, or near the topping phase. So look out for that. But we still have, as we saw from the previous chart, we still have green light buy signals. And beware the mature green light buy signals, because they're at the topping, the topping phase, or the mature phase of the cycle, if you like. So at this stage, I stop buying, I watch stops, and I look for trend line breaks where I consider selling with or without shorting. So this is putting it all together basically for the last confirmed call cycle, 24th of October to the 25th of February this year. And we've got the trends there on the mature end of the ascending triangle, the resistance at the top. And I've highlighted here the bullish divergence which precedes the call-up. You can see here, just on the baseline here, which is a flat price, and then we had the rise, both the MTI and the BSR forming higher lows, confirming some bullish divergence, and that preceded, as I say, the call-up. And then the bearish divergence here at the topping phase. We had basically the resistance levels here at the top of the ascending triangle, and then that was confirmed by a lower high for the MTI and a lower high for the buy to sell ratio, confirming bearish divergence, and that preceded the call down. And quick test results from the last cycle using the long-term winners search with the RTRB stocks I highlighted at the beginning. They typically returned about 21% using the confirmed call versus the 0.5% for the VVC, and the green light buy signal that returned ironically slightly less, but roughly about 20% on average versus about 0.75% for the VVC. So some very nice gains there. So the this last confirmed up signal was supported in summary by all three MT indicators. MTI, BSR and RT rose above 1, and they were rising before the call up was printed. All three started to rise on the 11th with a green light buy signal, and the canary starts to sing. All three confirmed bullish divergence with price on the 11th of October before the call up. All three confirmed bearish divergence with price on the 24th of February, leading to a call down. And that call down was the day after. All in the context of, very importantly, the ascending triangle uptrend of price. So this basically was a strong, reliable, confirmed call. But I've mentioned here, not all, each one has its own nuance and is determined by the matrix, if you like, the mix between the MTI, the BSR and the RT. And not all confirmed calls are the same. Some confirmed calls from the chart I showed earlier on the 9th of January, the BSR at the start was below 1. So just to summarize, the indicators are important in deciding our conviction of the signal in the context of the technical pattern of the trend, and can help us to know when to buy and sell. So examples of that are Lion Trust, Games Workshop. And going back then, this is the confirmed call I showed earlier, which is started on the start of the ascending triangle on the 9th of January last year, and all the way to the confirmed down, which is on the 13th of May. The nuance there was MTI was just above 1, RT was on 1, whilst the buy to sell ratio was below 1, it was 0.81. But the important takeaway is that all the three indicators are rising, and they were rising from near oversold areas as well. And the long-term winners Unisearch RS descending cherry pick RB returned something just under 15% versus 4% for the BBC. And indeed, if people had held on during that ascending wedge from that call up all the way before the recent sell-off, I'm sure would have done very nicely. I've given a few examples here of charts of some buys and sells. I'm sure quite a number of us will have been in the Lion Trust during that cycle. This basically, I've taken the chart back to 2018 to identify some Fibonacci levels, because we were making a lovely ascending wedge here pattern. The green line is my entry point when it broke through resistance, confirmed by a rising at the very early stages of MACD. The stochastic was a slightly earlier signal, and then all the way through the uptrend, the topping phase, and then sold out here just before the confirmed down. And this is the VectorVest stop, the actual shaded area. And I like to have little ratchet stops, which I move up and down as well here, which I put just under the previous low, and also the break of the trend line confirmed that as well. So that's Lion Trust. Similarly for Games Workshop, got in here, identified the ascending triangle, and I've used some Fibonacci levels here from the start of the trend. So we've taken this back to April, is it? April 2019. And breakout confirmed by the signals a bit early in terms of MACD, but the stochastic gave us an early signal, and then rode the uptrend. We had the topping phase and then sold out just before the confirmed down. I think it was on the 24th. And where Games Workshop, I think it just got over the 1618, and I think on Lion Trust, I think that did hit about 2618 Fibonacci levels. And then going on to the SUK2, where I did in fact take out a hedge position, where we had some bullish divergence, although it's not very well highlighted here. We did get some bullish diversion here to price around about the 23rd of January. And although I haven't shown it here, I didn't want to compress the charts too much, but there was a nice increase in volume. So obviously, it goes without saying, you need to be nimble with physical stops using leverage like SUK2 here. And then once it hit 1618, I did sell out, and probably the benefit of hindsight now was the wrong thing to do. But I had a Fibonacci target, so basically took profits with the view of trying to get back in, but it went so far, so fast, it just didn't give a chance for a nice elegant entry point, so I've just not done anything since. Okay, so where are we now? This is the weekly VVC price chart with the confirmed calls from 2011 to 2020. And as you can see, I've drawn a nice, what could be a support line here. Prices come all the way down to the support line. We've come to a Fibonacci level from this time span to the 61.8. Will it hold at this stage? Is too early to tell. Will it break down to the 786? Too early to tell. And we're at extremely oversold levels. And as you can see, the well, dramatic falls in the indicators there. So we just sit and wait and try to be patient. So you'll be pleased to know that this is the last slide, and this is my investment plan checklist. It's basically identify the technical patterns in the VVC for price, trends, turning points, confluence points, whichever you call it. I look for the first green light buy following a call down. I look for whether it's preceded by bullish divergence. If that's the case, even better, and I prepare a watch list. I ask myself the question, where are we in the MTI cycle? Are we in the oversold stage, or are we in the mid-cycle stage? Obviously, it goes without saying the potential investment return is greatest at the start of the cycle. That's the area to be bold. And look for the three indicators rising. Ask, is the canary singing? And I accumulate stocks if the technicals of the stocks then align with the market timing signal sequence, leading to and even past the actual call-up signal. And I let the MTI and the BSR indicators be a guide, if you like, for want of a better phrase, as the accelerator for buying stocks and dictate the rate of accumulation. In the topping overbought phase, be aware of the disappearing green light buy. Be aware also that any further green light buy signals in this phase, they are mature. But look for that disappearing last green light buy RT kicker symbol. And ask, is there any bearish divergence of price and indicators at overbought levels? At which stage I don't buy more stocks. I watch and tighten stops and consider selling at broken trend lines, valuation targets, fib targets, percentage gain targets. And consider shorting if we are so inclined as a hedge or a standalone position, depending on one's risk profile and investment style. So as I started, just to end, always keep an eye on the MTI, as the US says, and ask yourself the question, is the canary singing, and are the indicators rising with price and trend? So on that note, I'll pass you back to David, and thanks for listening.
Calvin, thank you. That was a wonderful presentation. I'm really glad to hear that somebody else uses the word preceded. I thought that I was the only person in the universe who used that word, but there's two of us now. So got a couple of questions here. First of all, from Richard, he wants to know, he's new, and how long did it take you to get to this level of proficiency in using VectorVest?
Yes, I must say, when you first start out, it is a bit of a learning curve because there's a lot to the VectorVest system. It took me a while to know myself and to know what signals to take. It's so easy when you start off, you want to chase the returns and get the quick returns. And what I'd suggest is just take it slowly. And, you know, the markets are going to, if you don't take a signal today, the markets are going to be there tomorrow. So if it takes you 3 months, 6 months, or a few years to get to where you want to be, then take your time. Yeah, so it does take a while to get there. And I'm still learning. You know,
aren't we all?
Yeah.
Or aren't we all? But the thing that stood out for me from the presentation, apart from the actual detail, was the trading plan that's been put down on a piece of paper, summarized and to the point. And ladies and gentlemen listening, that is a rite of passage. At VectorVest, we can do our best to do most of it for you, but at the same time, we can't do your press-ups. You've got to do your own press-ups. And sitting down over a weekend and putting together that trading plan that suits your objectives, that suits your personal beliefs about markets in the way that Calvin has just done, is a rite of passage. So that was just wonderful. Richard asks, have you tested the indicator cycles in a previous market correction?
Yes, I think when we had the days of the Bristol user group run by Malcolm, and I think I did go back and try to sort of do a little back test, if you like. And one thing I noticed was at the time, if the BSR wasn't above 1, I think it was, it tended to be less of a less reliable signal. But the nuance now for me is more to do with the rising indicators, even if the BSR is below 1 when you do get a confirmed call. So look for the riser. The one way to check it is if you, from memory, if you bring up the market timing chart, and if you click on the cursor, the crosshair cursor on the top of the tab, one of the tabs on the top of the chart, and if you use the crosshairs then just to highlight where the confirmed calls arise and you go back in history, they do tell you the numbers on the right-hand side of the chart. They can tell you the value of price, the value of the indicators as well on the right-hand side. And that's quite a it's like an eyeball test, if you like, and it's quite easy. It's quite fast, a fast way of doing it. So that's what I would suggest, is to do that and use the crosshair cursor. Okay.
Well, we've got Alan says here, brilliant presentation, most helpful. Roy from Cape Town says, excellent presentation, well done. Steve, who's our user group leader in Oxford, says, Calvin is brilliant, excellent presentation. And he's got it in big letters as well, so he's shouting it the whole way from Oxford at you. Jonathan says, very good. And Morgan, one of your countrymen, says, a lot to take in. And he says, lovely charts. Yes, you put my PowerPoint to total shame, sir. Malcolm says, Malcolm Mackenzie from that you know from Bristol.
Hi, Malcolm. Yes.
Says he says, do you return? He says, well done, Calvin. Many thanks. Do you include dividends in your 15% target return?
Yes. I must say I tend to go more for capital gain than dividends. So that's the majority of the return. So yes, that's any dividends I do get. That tends to be about 1.5 to 2% typically. That would be the total return. Yes, I'm quite happy with that. And if I can compound that every year on average, I'd be a very happy bunny. Yeah.
For sure, for sure. Anyway, Chris from Florida says, thank you very much. Great presentation. Steve Goff, who did the RT40 2 weeks ago, says a very in-depth presentation. Divergence works very well in the MTI and the BSR.
Mm.
Ed Jones, who's a great trader in London, I've known him for 15 years. He says, super, many thanks, Calvin. And Nasca says it was really excellent. And Nigel James says, incredibly detailed and lots of hard work. Thank you. And Brian, Cape Tony and now living up in Manchester, says, fantastic presentation. Julian says the same. Russell says the same. And Nasca, yes, they're all VectorVest charts. I'm answering that for Calvin. Bill says, not being a market timer in the past, after Calvin's presentation, I'm now convinced of its use. Well done, Calvin. That's wonderful.
Thank you.
I'll send the slides. Calvin hasn't sent the slides to me, but and anybody who wants, Calvin's got better things to do in his farm to answer emails. So email me, and if I can't answer the question, I'll pass it on to Calvin. But I don't want the dear boy inundated with 200 or 300 emails. So I'll filter those out. Calvin, if you send me the slides, if you're happy, then I'll distribute those to anybody who wants them. I think, folks.
Yes, you're very welcome.
Yeah, that's great. Thank you. I think the really important thing for me, the detail was absolutely wonderful, but the really important thing is that Calvin's emphasized the need for a structured plan that when the little bar is moving up and down and scaring the living daylights out of you, that you don't have to think of what you're going to do. That's absolute. And the shorter the time frame, the more important that becomes. Philip says, I really like to see the investment plan checklist. Okay. Most helpful to see what drives other investors. Great stuff. Thanks, says Phil Berry. And David Gabriel says, are you limiting your investment under 1% of your account? David, I think that what Calvin is saying there is that the risk, the amount of cash loss between the entry point and the stop loss is 1% of the account. Am I correct in that, Calvin?
Yes, that's right. In fact, it's your formula, David, that I've used, and I found that helps immensely. Yes, absolutely. So never more than 1%, typically more like 3%, or even less, 0.5% if it's more of a more risky stock.
Yeah, well, that's kept me alive for 35 years in these markets, one little formula. So, David, if you buy a share at £10 and you decide to leave at £8.50, then when the market falls from 8 to £8.50, you've lost 1% of your account. That's the simple little formula, we'll get the slides, Nasca, don't worry. Alan says, when did you start with VectorVest, Calvin?
Oh, crikey, that's a good question. I think it must be, 3, 4, 5 years ago, maybe. I can't actually remember.
It was that presentation I did in Bristol at the Marriott Hotel.
Yes.
I'm sure, yes.
Yes, that's right.
I'd just flown in from South Africa that morning, got the train from Paddington to Bristol, and did the presentation. Mark Kyle, who's an earnings per share king, said, thanks so much for the information. Have you ever looked at an absolute level of BSR to go into cash, i.e. 0.7 to distinguish confirmed downs? I know that Mark has done a lot of work on that himself. He presented it in Guildford the other day. So
interesting. Yes. I normally look at the trend line break. Once those stars are aligned, with the indicators and the ascending triangle example in the presentation, and then once there's a trend line break, that says to me, well, it's time to wake up now and say, right, is this the time to consider getting out? But I suppose, you could use the BSR as more of an indicator when to sell. Yeah.
Okay. Good.
Might get you out a bit later, but yeah.
Okay.
Sorry.
Good question here from Bob. He says, do you buy in one tranche or do you actually ease into the position once the stock is moving well?
Yeah, I tend to work out the formula like the risk to capital per share sort of when buying. First of all, I don't tend to add. Maybe I should consider doing that to try and sort of improve a bit and make more out of it. But I tend to then, once I've bought one, I tend to just stick with that tranche of shares, and then I try to diversify across different sectors in different shares.
Okay.
And if I can hold about 10 or 12 stocks, I'm happy with that.
Well, that's great. George says, excellent presentation. And France from South Africa, very good look at the inner workings of VectorVest market. Now, Paul Larkin says, brilliant. Diane says, thank you for sharing. Paul Kelly in Belfast says, excellent. And Anthony says, it's the best yet. Joanna from
nice to see.
Says really helpful. Clarity of thought, Lillian says, and all the lots and lots of really. Mike says so much experience among the VectorVest community, that's for sure. And Susan says, I really like the way you've your homepage. So that's great. Thank you, Susan. Guys, Rob from Oxford says thank you. Folks, we have to round off now because although you guys don't see it, there's a big sign coming up at the back saying I'm running out of bandwidth here. Cheers, everyone. And we'll speak next week. You'll be stuck with me again next week. I still think that we just need to be patient, and the most aggressive signal would be a green light. And just remember, we want to see the number of advances being double the number of declines during that green light. Thank you once again, Carwyn. Wonderful presentation, folks.
Thank you.
We'll see you all next week. Take care of yourselves. And just remember, the structured trading plan needs some thought, ladies and gentlemen. Take care now. Bye-bye.